I don't think I see that work.
All right. We're going to go ahead and get started. Welcome to the SD Launch and Learn with Mason Hogue, an attorney with Nelson Mullins. Today we are discussing capitalization tables, or cap tables as we call them. Before we begin, I'd like to go over two housekeeping items. First of all, if you can hear me, please raise your hand in the webinar controls. Thank you, John Searcy. Kevin? Great. Thank you, Anthony and Amanda. All right, great. Second, on the format of today's webinar, we will keep all audience audio muted. So if you have questions, please feel free at any time to type them into the webinar controls, so same webinar controls. We will pause about 20 minutes in for Q&A, and then again, we will have a Q&A period at the end. I will be reading those questions out loud, and Mason will be answering them. My name is Julia Linton, and I serve as the Operations Manager for SD Launch. Please join me in welcoming our speaker, Mason Hogue, as he dives into the basics of a cap table. Mason is the Assistant Corporate Group Leader at Nelson Mullins and serves as the co-head of the Technology and Procurement Industry Group. He is a business attorney and often serves as outside general counsel to growth companies. Also on the line with us, we have SD Launch Regional Manager Lee McElwennan. Mason and Lee, I'd like to welcome you here, and the mic is now yours.
Thank you, Julie. It's a pleasure. Thank you, everyone, for joining us. This is Lee McElwennan. Mason and I are joined here at the FCRA office in Columbia. Hopefully, we will not have a train go through, and so we'll be able to proceed well through this. And we look forward to getting questions from everyone. I'll turn the floor over to Mason, and we'll go from here.
Both Lee and Julia, thank you very much, and it's very nice to be here today. The topic of the discussion today is to go through a sample hypothetical capitalization table as a company grows and raises capital. In this hypothetical example, as you'll see, the value of the company is increasing as capital is raised. We thought it would be useful just to give a sample scenario of the effects of raising capital basically on the founder's ownership, the percentage that it owns, and we'll show some sample calculations as to what the founders and other investors would receive in funds at exit under various sell scenarios. So on our first page here, I'm showing the starting point where we have two individuals of CloudCo, each receiving 1 million shares. For purposes of this, we're going to say they didn't put any money in. They contributed their sweat equity and their ideas and their IP, and they each own 50% of the company. So after that, in a not unusual situation, the founders are seeking a little bit of money to kind of get off the ground and get started. And in this example, you'll see that they found some money from a group of family and friends who are investors. And I'll show you kind of an example here. It was agreed upon with them that the current value of the company is $400,000, and that drives the price that those investors would pay per share if they invest $100,000. So the net result of those family and friends investing at a pre-money valuation of $400,000 and investing $100,000 is the net result of that is that they would get 20% of the company, which is 500,000 shares, and you can see the dilutive effect of that to the founding shareholders. As a result of that, the founding shareholders' ownership interest goes from 50% down to 40%. So at that point, they've got investors owning 20% of the company, and they have $100,000 to spend to grow the company. So the next thing that's not uncommon in a company is you're bringing on board certain employees, your cash and capital is limited, and you'd like to have a stock option pool. And in this scenario, the company has decided to set up a stock option plan and pool reserving for issuance in the future and going forward 500,000 shares. And you can see that if all of those options were issued and exercised and turned into stock, as a result of that, you would see that kind of employee and other option owners would own 16.7% of the company. And that's diluting the family and friends down from 20% to 16.7%. And now the founding shareholders are down to 33.3%. If all those stock options are not issued and exercised, then the total amount outstanding at, for example, the sale of the company might be $300,000 or $400,000. As a result of that, the founders, the family and friend investors would have a higher percentage of the company. So now we're about to run out of our $100,000, and we're starting to seek additional capital. We've identified an angel network that's willing to invest in the company. And you can see under this scenario that now it's been negotiated and established that the value of the company is now $1.2 million. So in this example, the value's increased threefold from the point in time that the family and friends invested. But in this situation, this angel group would like to receive preferred stock. I didn't mention it expressly, but the prior investment and the founding shareholders and the option holders all have common stock. So their rights are the base level rights that you have in a company with respect to common stock. The difference between preferred stock and common stock, this is for a kind of a more detailed seminar. We're going to talk about the basics of preferred stock. Preferred stock can have many different types of rights to give it preferences over common stockholders. But the most common features that we're going to run through the scenario today is basically a preferred stockholder typically at a minimum gets the money that they invested back first in the event of a sale of the company. So in this scenario, you can see the angel preferred invested in that pre-money valuation. They own 25% of the company, and you can see the dilutive effect that it has to everybody else. You can see the founders now own 25% of the company each instead of 50% each. And we'll talk about this a little bit more later, but the example of a preferred stock situation is if the company in the next year performed very poorly and it had to sell, and it sold for $1.2 million. That's all it could get. What preferred stock, basic preferred stock means is that the preferred stockholders get to opt between receiving their money back or receiving a pro rata portion of the proceeds. And a pro rata portion would be 25% of the proceeds. And if the company just sold for $1.2 million, $1.2 million is greater than 25% of $1.2 million. So the preferred holders would take $1.2 million. Not great for them, they just got their money back. Everybody else would be wiped out. The family and friend investors who invested $100,000 would not receive anything, and the founding shareholders would not receive anything either. The other thing is called participating preferred stock. And what participating preferred stock is a different type of basic stock that you often see. And what it means is that upon liquidation, somebody receiving participating stock, they both get their money back, their original investment, and they also get their pro rata portion of what's left over. I'm going to leave that at the moment because we're going to show some examples of participating preferred stock at the end of this exercise. So, the company's taken the angel fund money, it's invested it, it's continued to grow. It's really increased its value, it believes, substantially. But it's not in a position to establish that value for certainty. It's run out of money, and it's in the midst of trying to raise new preferred capital. But it's out of money. It needs to make payroll, so it's looking for sources of funding. A not unusual situation is a bridge lender willing to loan money. They say, we're not going to negotiate the value of the company, and for some incentives, we'll loan you some money that will convert into your preferred round that you're anticipating having. And so you can see in this particular scenario, the bridge loan amount was $250,000, and the only key term associated with that particular bridge round is that the bridge lender said, whatever price you raise per share in the next round, we want to buy into that round at a 20% discount. So, if in the scenario you're going to see below, that the money was raised at $250 a share, and you can see from these calculations that as a result of that, the bridge lender gets to invest at $2 a share. So the bridge loan is sitting out there at $250,000. It's earning interest. The interest is 10%. So those are two key features: 10% interest and a discount of 20% in the next round. So the bridge loan is sitting there, and you can see the company 6 months after the close of the bridge loan successfully has raised a VC round. And you can see that round is raised at a pre-money valuation of $10 million. So in this situation, you can see there's been a significant increase in value over the angel preferred equity that was at a valuation of $1.2 million. So as a result of that, it has a less of a dilutive effect on everybody, but there's a lot more money being raised in this round. You can see on this scenario that the company's raising $3 million, and as a result of raising $3 million at a $10 million pre-money valuation, it is getting shares that represent 22.5% of the company. So if you walk through that, the key thing you can see from the founders' perspective, the founders originally owned 100% of the company between them, 50% apiece, and now they own about 18 to 19% of the company apiece. So if you're a founder in a company like this, which is successfully growing and successfully increasing its value, it still has a loss through the dilutive effects of issuing shares to others, a lot of its original ownership interest in the company. So that is the primary kind of basics that we wanted to provide as to the dilutive effects of capital raising. This company has gotten some friends and family money. It established a stock option pool. It's issued, for purposes of our examples, we're going to say that it's issued all of its stock options. Another thing to note is whether or not all those options are issued, these subsequent rounds of capital, like the angel preferred equity and the VC round, they're going to treat those options as outstanding. They're going to say, we're not going to treat them as not issued and outstanding and put our money in and then have you issue options that dilute us. So in the negotiated deal scenario, typically the preferred holder are going to have a lot of other rights that are for a different course, a different day. But one example would be you can't establish a plan that issues more options than the 500,000 that you have without our approval. And whether issued or not, we're going to treat them as issued for calculating our percentage interest in the company. So obviously, if the 500,000 shares of options were never all issued, the VC actually would end up receiving higher than 22.5% of the company, but also everybody else's ownership interest would go up a little bit as well due to there being less shares issued and outstanding under the stock option pool. So this may be a good time for a break if there are any questions.
That's a good idea. So at this time, but this will be a prudent time for a break. If you would type in your questions, and Julie, I'll turn it over to you for this time.
Okay, that sounds great. Thank you for that initial overview, Mason. If y'all want to type in your questions to the question, horizontal bar in your webinar controls, that would be great. We'll get some questions coming in, and then I can read them out loud, and then Mason will answer them. While some questions are coming in, Mason, I've got a question for you here.
Sure.
What is the kind of point where a company says, okay, I am opening only preferred stock, or I'm only opening common stock? Is there a point in their life cycle of their company where they say, okay, now I need to open preferred? Or could they always choose to keep their stock options as common?
The talking about not only the stock options but the capital you've raised from the investors as well. Is that the question, Julia?
Correct. Correct.
Yes. A lot of that ultimately is going to end up being driven by the investors, and I can give you some examples. Family and friends, you usually have some more flexibility that they're lending a helping hand, and they will be willing to treat themselves like the founders and go along with the founders and not get their money back first. Also, that's an opportunity for people if they are, wanting more equity percentage in the company rather than the preferred rights, and they focus more on the percentage interest that they get in the company. So if you see in our examples, you'll see some of these sell-side examples. The original family friend investors got 20% of the company, $400,000. So if this company does really well, that's a low valuation at which they got 20% of the company. And the ultimate equity investors in the final VC round got 22.5% of the company for $3 million. And so there's a lot more risk, and there's some upside early on with respect to getting a higher stake in the company. So you'll see even sophisticated family and friend rounds saying, I'll treat myself like you, a founder, but I'm expecting to be treated with my money as a real stakeholder of pretty significant interest in the company, because they're wanting the big percentage more so than getting the risk protection on getting my money back first. When you get into the more sophisticated investors in the later rounds, if it is, a venture group or sophisticated angel group, they're almost always going to require that it be preferred stock, that they get their money back first. That if you can't grow the company, you as the founders, and we have to sell, we're getting our money back, and you're going to lose your equity. You're not going to get anything back because it's sweat equity that you hadn't put in money in the company. Now, we do see some situations where a company can successfully have maybe more limited needs for money. Sometimes we see this in like cloud computing SaaS companies where they can generate enough revenue quickly enough that they can run their business and meet needs, and they have more limited amounts of money, and they may stick to raising money from a close network of people that they know well, who are sophisticated about businesses and are also willing to continue to take and buy common stock instead of demanding preferred stock, and sometimes fund money as needed as the company grows. But otherwise, the more sophisticated funds and angel groups, I think you're almost always going to see it be preferred stock that they require.
Great. Thank you. All right, so we've got a couple questions coming in. One is convertible debt ever used, and can you discuss convertible debentures?
The bridge loan is, in essence, a convertible debt instrument. Now, the bridge loan is defined as a bridge loan in the sense that it is bridging to a contemplated next round of capital, and the bridge loan will have some special features to it that we didn't talk about, like it'll say, in the event that you don't raise that money of at least X amount, of at least X valuation, within 1 year, then I've got certain rights. I can demand all my money back with interest. As an alternative or a kicker on top of that, I'm entitled to convert into common at a pre-negotiated price. So those are the kind of things that a bridge lender could consider requiring. But in kind of the startup environment that we see, it's bridge money related type debt financing. On top of that, I think it's worth, Lee, you mentioning some of the types of debt that SC Launch offers and some of the features of that.
Yeah, so that's a good point, Mason. So we do see with the investments that we make in startup companies, in some cases a preference for convertible debt, and it will have participation rights, a cap. So there's other language that we put in our agreement, but that's oftentimes the preferred tool, specifically if the company is not planning to do a priced round. They haven't gone into equity. They haven't done a seed round yet. And so they're looking to try to do something on a debt scenario versus directly into equity at this point in time.
And Lee, that's a good
Okay,
point.
so I
So go ahead. I was going to say that's a good point because we have a lot of clients that have received debt-related equity financing from SC Launch, and that's a little bit different flavor that you're offering that money without there being a definitive, okay, it's for raising capital. And a bridge loan typically is if you raise money at a certain price, the bridge money has to convert. You force the conversion.
Right.
Don't necessarily always have to do that, and some of the monies that SC launched has been a different flavor of that because it hasn't been with anticipation of a
defined,
definite raise of capital from the VC fund. Go ahead, Julia.
Okay, so I have a question here that is going to piggyback on this nicely. Do you ever see situations where the bridge financing is secured with IP or other assets?
We see situations where bridge lenders are requiring that and demanding that. And if you are, in a dire need of money, you may have to do that. And you would have to examine your documents associated with the other preferred equity investors if you already have some in the company, whether that would be allowed or not. That would be a last resort situation because that does basically mean that in the event of a default, they're going to be a preferred creditor over all the other equity holders, and they're going to get to take the whole company in terms of its assets and sell it to satisfy the debt rather than being unsecured. In my career and experience, generally, I don't see securing the capital, the assets of the company on a bridge loan. You do it when you have to.
Yeah, agreed.
Okay, thank you. So we don't have any other questions in the queue for right now, but to all the attendees, please feel free to keep those questions coming. But for now, Mason, I will hand the mic back over to you.
Okay. Before we go to these sections, but you can leave it there. I thought I would mention just a couple of other things so people have kind of an understanding of some of the issues associated with preferred type rounds. Just to be familiar with it. The scenarios that we are going to go through mostly show some increased values in the company and some distribution results. But there's one thing that as you're raising capital, you could face a situation where you have a down round, that you've spent the money from a group of investors and you need to raise more money and you've not increased the value of the company. The example that I showed you had us going from, pre-money valuations that started, like $400,000, went to 1.2 million, if I recall, ultimately in the angel preferred round, and ultimately a $10 million valuation. So they increased over time. If you had a situation where after that, it wouldn't be good, but after that 1.2 million valuation, you need to raise more money and you've dropped in value, you could find yourself in a situation where that angel preferred round has some additional rights that protect those preferred holders. And a key one is called anti-dilution rights. And there's different flavors of it that we don't have to get into. And some are more penal on the founders and other common stockholders than others. But the essence of it is if I pay a price based upon a $1.2 million valuation, and then you raise money later at a lower valuation, you've got to give me more shares because I'm not going to allow you to sell shares to subsequent preferred holders at a lower valuation and dilute me as a result of that. And so I've got to get some more shares. So that is a feature of preferred. Another feature of preferred that can exist is a dividend, pretty common. For purposes of our calculations, I didn't put it in, but you can think about it if it's a 10 or 15% dividend and it's participating preferred. If the company takes 5 years to have an exit, that's going to increase by 50%. The amount of money they get back, because they're going to get 10% back times 5 years, which is 50% of their investment plus their investment. So those are all kinds of things that you ultimately look at when you're negotiating your particular preferred deal. Non-economics also include things like preferred holders wanting board seat rights, sometimes wanting control over future equity capital raises. You can't do it without their consent. A whole host of other things that, when you are in the middle of a preferred equity round, you deal with. There's usually a stock purchase agreement that has a number of reps and warranties about the company, and a host of other things. So we're mostly focused today in this presentation on some of the key economic terms, kind of in an up-round situation of the value of the company increasing. So that just gives a little bit more background about some of the other things that you're dealing with when you're raising preferred equity from sophisticated people. So with that, we will turn to some examples. What I'm going to do and walk through is to show 3 different scenarios where the company ends up selling. The first one is a bad situation. We raised money at a $10 million valuation, and we were unsuccessful. If we liquidated and got nothing for the company, all was lost. I haven't shown that scenario, but nobody would get any money. It would be zero for everybody. But what I wanted to show you was just the basic effect of, what happens if we sell the company for basically the amount of money that came in from the preferred holders. And so you can see, in this scenario, the ownership percentages show the final ownership percentages after we'd raised all the money of everyone. And the amount invested shows what everybody has invested in the company. Stock option holders, I've said exercise price. For purposes of this exercise here, we're assuming that all the options, all 500,000, were actually issued. They typically have an exercise price. Those exercise prices are typically tied to the fair market value of the company. And as we, increased our value over time, those exercise prices would be higher than the value they're going to receive in distribution, and so they wouldn't exercise. But for purposes of our discussions here, let's just assume the exercise price was close to zero, and all of them, that nobody's having to pay anything to buy their options to become a stockholder. So in this scenario, it's showing you the results if you're a participating preferred holder and a regular preferred holder, with a regular preferred holder, again, being you opt between getting your money back or being treated as a common stockholder. Here in this scenario, because the sale price is exactly what was raised from the preferred equity holders, and that includes the bridge lender who converted into preferred, you can see that basically they get all their money back and nobody else gets anything. So the family friend investors, they rolled the dice. They got for only $100,000. Once the money was raised from the DC owners for the final time, they still had 9.38% of the company. They were diluted more than half from their original 20%. 9.38% of the company compared to 22% when they invested $100,000 versus $3 million. If this company has continued to grow, they would be sitting well in that bet that I said by taking 20% common would work well for them, and we'll show that example in a minute. But here, the company didn't grow, it failed, so they lose all of their money, and the preferred holders get their money back. Had we sold the company for a little bit more money than the $3.662 million, you would start seeing some money pro rata going back to everybody else. The preferred holders still would have taken their investment back under the regular preferred, because you would have to get a valuation of sale that's high enough that the sales price times 0.225 times 22.5%. That would be the point at which any value above that would exceed their investment, and if they were a regular preferred holder, they would convert. And so, that's almost 5 for the VC preferred holders at 22.5%. That's a good bit higher number. It's a lot higher than this liquidation scenario. So we're going to go to the next example. The next example is a situation. Remember, we raised money at a $10 million valuation when the VC preferred holders invested. So what we're seeing here is a scenario where the company sold for $14 million. That would not be considered a success overly for the VC preferred owners. They're only getting back a return. You're going to see the returns, but the value increase is less than 50%. We'll walk through a little bit of the examples that you can see between participating preferred and regular preferred. Let's look at the regular preferred scenario. I mentioned earlier that there's a point at which the preferred owner's pro rata proceeds of the sale price exceeds their investment. And if they have regular preferred, they're going to opt to convert and get that pro rata treatment. And here's an example where you can see that. 22.5% of $14 million for the VC preferred holders in the bottom number is $3.15 million. That is higher than $3 million. So they're going to take, if they had a regular preferred stake, $3.15 million. It's the same thing for the bridge lenders, and in particular for the angel preferred holders. The angel preferred holders invested at a lot lower valuation, so their investment was $400,000, and their pro rata percentage of 18.76% of $400,000 is $2.6 million. They're going to take that. So you can see the effect of this in the right-hand column of regular preferred. The founders have, done at least reasonably well in the situation that they each got $2.6 million. You can see here where the family friend investors did, very well with a regular preferred. They got a 13x return on their investment. So investing early and getting a higher percentage of the company and taking common rather than preferred worked very well for them. Tacking on another $100,000 on that, to get their money back and participate is not all that meaningful. So it worked very well for them. The other investors, in particular the bridge lenders and the VC preferred holders, by taking regular preferred, they suffered in the sense that while the founders and the family friend investors are making a pretty big return, and you've got $1.3 million going to the stock option holders, and the angel preferred investors have also done relatively well at the $1.2 million valuation. You've got the bridge lender and the VC preferred holders barely getting their money back. This is the reason for participating preferred. A participating preferred concept is, if we sell for not a lot more than or a low multiple of the original price, some of that has to be taken out of the early investors' pockets as common holders, and I got to get my money back and participate to get a real return. So look at that participating preferred column. Look at the VC preferred holders. Regular preferred, they get $3.15 million. As a participating preferred, they get $5.325 million. The basic math on that is you take the $3 million, the bridge lenders $262,500,000, and the $400,000, and that's the $3.625 million. You deduct that $3.625 million from the $14 million, and you pay that to those preferred holders. And so that's about, let's just round that to $4 million. That leaves $10 million, a little bit over $10 million left to distribute to the stockholders. Then the VC3 preferred holders, they get 22.5% of that as well. So that is why they go from $3.15 million to $5.325 million. They get the money back and they participate in what's left over. And so their return, gets to don't know, around 80%. It's not a 2x return. It's under a 2x return, but it's not, 3% above their investment, which is basically somewhat like what 3.15 million is. And you can see the bridge lenders have a similar pro rata effect on their participating preferred. The angel preferred holders, their bump is different because they get their money back and then they participate in what's left over. And just based upon the economics of that, their actual money goes down a little bit because they're getting their money back at $400,000. The VC3 preferred holders are getting their money back of $3 million. And so you can see the effect that it has on everyone. I mean, it is a meaningful impact on the founders. They are losing around $700,000 in money, which is probably, it's 25% or so, but it's a decent chunk of money. But when you look at it and you go to that VC preferred owner, well, that actually kind of starts to look and seem fair. We were responsible as founders for growing the company significantly, and we didn't. And so the preferred holders are going to demand that they get their money back. So we talked about participating preferred. There's other types of participating preferred, like 2x participating preferred, which means they get double their money back and participate. I haven't run calculations like that, but occasionally you see things like that. But that is, you're as a founder, you're saying we're going to grow this company substantially. We're all going to make a lot of money. And then it can be put your money where your mouth is, because if you don't, you just grow it a good little bit. I want to guarantee at least a double return back before you get anything. So I want 2x participating preferred, get double my money back, and then participate in anything that is left over. But you can generally see it shifts the economics a good bit in a situation where you're selling for not a great significant amount over what the value of your company was in your last round. But you can still see that the family friend investors, I think that they probably would say they still did well. The value of the company increased substantially to $14 million from the pre-money valuation of $400,000 that they invested in. And so they still are getting close to a 10x return and that's a good benchmark to look at, because it's hard to benchmark it for founders who didn't make an investment in something, but they're still getting a meaningful return, even though it is, almost, it's about $350,000 less than the regular preferred. So the difference is the way participating preferred works is if the company sells for a lot of money, then the participating feature doesn't really have much of an impact on what everybody receives. And that is what we're going to next.
Hey, Mason, this is Julia.
Yes.
Before you go on to the next one, a question came in. If I could go ahead and ask it. It says, is the participating versus regular preferred decision by the investors made at the time of the investment, or can it be made as a function of the sale price?
It is made at the time of the investment. And the reason for that is the investor wants to know what they have in making a decision about whether they're going to invest. And it is all a scenario of the prospects for your company, the industry of your company, the current dynamics of whether there's more money to invest in companies than there are companies to invest in, just the particular market at the time. But it's upfront because the investor is basically saying, I want to know that if there is a down round, not a down round, where there's a scenario where you sell for more than the value I invested at, that I'm still going to get my money back plus participate. And I'm not willing to invest because I'm counting on you to grow the company substantially. And if you only grow it a little bit, you just have to accept the fact that results in you getting less money.
Do you still see participating preferred as well as the regular preferred? Where do you see the most?
We do see, a variety of different, and all these features. There's a lot of other features that Lee knows as well, and anti-dilution rights and all other kind of control features. But we see, a range of things just depending upon the circumstances.
Okay.
Yeah. And the attract. I mean, to the extent a company's got the ability to demand terms a little bit very attractive to a number of different investors, you're going to be in a better spot, as to what you may offer. And by the way, a different easy feature that is different than participating preferred, but gives a preferred holder return is a dividend. So that's a fixed, guaranteed return, but that goes to grow fast and sell fast if you don't, the dividend accrues. So, there's flexibility between participating features and dividend features and those types of things.
Okay. Julie, any other questions?
No, I'm sorry. You can go ahead.
Okay. So the final slide here is talking about what it looks like when the company sells for $100 million, which is what everybody would love.
Right.
Everybody would love that. Honestly, we see, all kind of ranges of sale prices, but, 100 million is a good number to go with for purposes of, usually if a company's selling for $100 million, oftentimes they've raised more capital with different rounds, and they may have had higher valuations on their capital raises and a number of other things that have occurred. But this just kind of shows a company that, in my view, was relatively successful, that it raised a limited amount of money at relative to the final sales price, very attractive low valuations. And a result of it, it's a very happy scenario for everyone, with everybody receiving a lot of money. And the relevant thing to note is between the participating preferred and the regular preferred, because the money is so big, giving those original investors back their $3.625 million has almost a negligible impact on the difference of what everybody receives, including the VC preferred holders. But you can see the VC preferred holder and the participating preferred, the answer is always going to be the total number they're getting is a little bit less than their $3 million investment. But you can see that the difference is a little bit less than $3 million. But even then, they're like, yeah, I like getting 24.675 million, but they're really getting that much difference between 24.6 and 22.5. It's 2 point something million, so it's less than 10%. Once you spread that money out amongst everyone else, the impact is relatively low. I mean, a founder is getting about $700,000 less. $700,000, but they're getting $18 million. And the family and friend investors, which we benchmarked before, it's a good thing to look at. Look how they're doing. They're getting $9 million back as compared to about $9.4 million. So they're getting a huge return on their investment, and it's very negligible having to give up a kind of a pro rata portion of that $3.625 million. So that's, you can see with an example how participating works, and that's the purpose of participating preferred. Even if it were a 2x participating preferred, where you had to give the preferred holders back, it's about $7.2 million or so, still would be very significant returns for everyone if the company sold for $100 million. So with that is basically the discussion today. I'd be happy to answer any questions from anybody, or from Lee or Julia, or any other comments that Lee may have.
So thank you, Mason. I will, in just essence of time, Julia, do you have questions that people have sent in, or I encourage everybody to go ahead and ask questions now. Thank you.
Yes, I do. So we've got the questions coming in. The first one on the table, first of all, I'd like to just thank you, Mason, for the time today. I really appreciate it. Great presentation, very informative and educational. So the first question on the table is the bridge lender preferred holder example similar to an early friends and family round convertible note scenario? So I can repeat that if you'd like.
No, it is. It is. You can also see very early, and that's a very good question. It's not uncommon for friends and family to say, or the company to say the following, and I'll give the reason, is to say, we're not sure what the valuation is, and neither party is sure what the valuation is. But the friends and family go, we want to help you, so we'll loan you the money, and then it will convert into your next round. So let's talk about some pros and cons of that for both the investor and the company. The pros are, for that lender, is they don't end up in a situation where they agree to too high of a valuation. And so they're not getting enough ownership interest in the company. And they're going to get just diluted and hammered and never make any money off of their investment. The downside is if they're really sharp and astute and can evaluate the situation, they may feel confident that they can get a low valuation now and get a lot more equity in the company than they're going to get in a conversion. What they give up is if that next round is in preferred, they don't get to convert into preferred, but they like the fact and they're confident that they can get a higher valuation than what the company's going to raise money for. So the flip side of the company, what it has to be cautious of is, a company going, that's great, I got that money from family and friends at a low valuation. I only had to give up 2% of the company to get $100,000. Well, that actually, while that sounds great, that can be a disaster scenario down the line when they're all extremely unhappy with you, that they basically, are out of the company because you ended up, having to give, if you gave 1% of the company to raise that $100,000, and then you're in a crunch, and you have to give 50% of the company to raise $300,000, then you basically have wiped out those family and friends. And there are actually investors who say, I'm not coming into that situation where I have a lot of unhappy family and friends that are getting wiped out because they invested at too low of a valuation. We're going to have to recapitalize this company somehow. So it's not always the best thing in the world to, raise a little bit of money at a really high valuation where they don't get a lot of equity in the company. So there's the play that you see. There's also something called safe agreements that you can look up, which is it's not debt, but it's the same effect of providing money to a company that can convert into equity. And those are a very common thing that you're seeing today. It's called SAFE. And they're just kind of a little bit simpler. And these bridge loans and these convertible debts have a lot of different features to them, like we mentioned before, that actually are more appropriate when you don't know if you're even going to be staged to raise money. And if you do a convertible debt instrument, you probably do need to consider, or a investor may want some hammer rights, like, well, if you don't raise money within the next period of time, I want from $100,000, I want it to convert into 50% of the company for your penalty in saying you can raise money. So you see all flavors of bridge debt as well.
Thank you. Thank you. So their question here on the table, we'll let you catch your breath. In the $14 million sale participating preferred scenario, the bridge debt holder proceeds increased along with the VC holder, while the other investors funded the difference proportionately. Could you please explain?
Yes. The basic math is, and I'm not a math whiz, and I did do these things, there could be some slight variations if I didn't get something exactly right, is that you basically took the $3.62 million and you wrote a check to the original preferred owners. And so you wrote a check $400,000 for the angel preferred holders, $262,500 to the bridge lender, and $3 million to the VC3 preferred holders. So that's off the table. So you basically subtract that $3.625 million from the $14 million. and that's going to give you just a little north of 10 million left. And let's just say, for the example here, it's 10 million flat. So then the next thing you do is everybody gets their pro rata percentage of that 10 million. The VC3 preferred holders gets 22.5% of it. The angel preferred holder gets 18.76% of it. And the founders get 18.76%, and on down the line. And so that's the result. That's how the math works. So you have to, with the preferred holders, add those two checks together that were written to them, and that represents the total they received. And so, yes, the essence of it is everybody else is taking the pro rata hit for that.
Okay, thank you. At this time, we don't have any other questions that have come in. Just a lot of people saying thank you so much for your time. This is an excellent session. If anybody has any questions, please feel free to reach out to Mason. I will email everyone this presentation if it's okay with Mason, and include all of his contact information. And as a plug for SC Launch, I'd like to say that we host these Launch and Learns monthly, or sometimes 2 times a month. And we've got some great ones coming up. Please check our website. In addition to that, we have the SC Launch Annual Summit coming up on May 29th. Please check out our website for that as well. And if we don't have anything else, I'd just like to say again, thank you so much to Lee and to Mason for your time. Thank you again.
Our pleasure. Thank you, Julia.
Thank you, Julia.
Thanks, everyone, for joining.
All right. Thank you all for joining. I'm going to hang up the session now. Thank you. Bye-bye.